Hello everyone. In the last session, we had learned to compute the taxable income from business. Today again, we are going to look at another illustration and learn how to compute taxable income from business. So at present, we have an illustration that is appearing on the screen. It reads as follows: Mr. X furnishes the following details of his income and expenditure. And we have a typical profit and loss account. We have the usual expenses debited on the profit and loss account and certain incomes that are showing on the credit side of the profit and loss account. Now, we are asked to compute the taxable income from business. Now, ideally, as I've told you earlier also, we look at a profit and loss statement. This is the account that is prepared from his business operations during the previous year. So ideally, the net profit which is reflected in your P&L account must be the taxable business income. However, it is not so. What is the reason? When you look carefully at the profit and loss account, you will notice that there are certain incomes which have been credited to the profit and loss account, but they are not of the business nature. They are incomes. Nevertheless, they are not business income. Therefore, they should not form part of your computation of taxable business income. Likewise, if you look at the debit side, you may notice certain expenses which are maybe personal in nature. It could be an appropriation, for example, like the staff welfare fund, or it could be a personal expense. Alright, so what we are required to do is compute the taxable income from business. So we take the net profit 75,000 and make adjustments in order to rectify these transactions which have wrongly appeared in the profit and loss account. So let's look at the income side. If you see, sales is a business income. Interest on securities, it is income. However, it is income from other sources. Likewise, capital gains short term are also capital gains and not income from business. We have bad debts recovered, which was allowed as a deduction earlier, and hence when you recover these bad debts, they will be taxable as business income and no adjustment or no treatment would be required. So these incomes which have wrongly been added to your net profit will now be reduced from your net profit to rectify the profits. Likewise, when you look at the debit side, purchases are business expense, rent, staff insurance, stationery, general expenses, depreciation, all these are business expenses. Transfer to staff welfare fund. It may be a business expense, but it is an appropriation. It is not an expense in the true sense. The funds are being transferred to a different fund called the staff welfare fund. Then you have the income tax, where the sole proprietor is paying income tax for himself. That becomes personal in nature and therefore inadmissible. Bad debts are business expenses, and of course your net profit. Let us now look at how to prepare the statement. I've already worked it out here for you. So here's your computation of taxable income from business. We start with net profit as per P&L account, which is 75,000 as was there in our P&L account. We add back the inadmissible expenses, or rather expenses which were wrongly debited in the P&L account. They are added back. You remember there were two expenses. One is an appropriation entry of staff welfare fund and income tax. And reduce or less all the non-business incomes that were shown in the profit and loss account. So you remember We had interest on securities, which forms part of income from other sources, and short-term capital gains, which comes under the head capital gains. So these two have been reduced from the net profit in order to arrive at your taxable income from business. So after all the adjustments, you arrive at the taxable income, which is rupees 3 lakh.